Welcome to this explainer. Okay, so if you're gearing up to tackle the Canadian investment regulatory framework, you are exactly in the right place. Today, we're going to decode the CIRE licensing exam material together. Our goal here is to build a crystal clear mental roadmap of this whole landscape and, more importantly, point out the exact traps and watch points they love to test you on.
To make sure all of this actually sticks, we've organized this material into a strict exam blueprint. First up, key regulators and rules. Second, the 4 registration pillars. Third, market trading and clearing. Fourth, essential laws and agencies. And finally, we'll wrap up with the critical distinction between regulatory and criminal enforcement. All right, let's not waste any time. Let's dive right in.
Part 1. Key regulators and roles, the who of Canadian finance.
So here are your core memory hooks. This is how you'll instantly identify which regulator does what, which is exactly how you're going to be tested. Think power for the provincial regulators and the CSA, because securities regulation in Canada is provincial. They literally hold the power to write the ultimate securities law. Think conduct for CIRO, since they handle the day-to-day member behavior and trading integrity. For CIPF, remember collapse, because they only step in if a firm actually fails. FINTRAC equals files for reporting suspicious cash activity. OBSI handles complaints for retail clients. And finally, OSFI is all about stability. They focus on the prudential health of banks and insurance companies.
Now there's a classic trap here, confusing OBSI and OSFI. I mean, they look super similar on paper, right? But their functions are worlds apart. You got to remember that OBSI is an independent service that handles individual retail complaints. And, key point here, their recommendations are currently non-binding. OSFI, on the other hand, is a federal prudential regulator. They're ensuring the institutional safety, capital, and liquidity of the banks. The absolute crucial takeaway, OSFI is not a market conduct regulator. They aren't looking at how a dealer treats you. They just want to make sure the bank itself doesn't go under.
Moving on to the Canadian Investor Protection Fund, or CIPF. Here's another massive trap, misunderstanding what CIPF actually covers. First off, it's triggered exclusively by firm insolvency. If the market crashes and your investments tank, yeah, CIPF does not compensate you for that. Second, please do not fall for the trick that it offers a flat $1 million total across everything. No way. Coverage is generally up to $1 million per specific account category. The 3 big ones are general accounts like your cash or TFSA, retirement accounts like your RRSP, and RESP accounts. So theoretically, a single client could actually have millions in protected assets as long as they're spread correctly across those distinct categories.
All right, Section 2, the 4 registration pillars, rules for the dealing representative.
Before we look at the actual steps, let me pose a quick question. If a candidate passes the CIRE exam, but they have no sponsoring dealer, are they officially registered? This is a huge exam watch point. Passing the CIRE alone does absolutely nothing to grant you actual registration status. You've got the proficiency, sure, but you are not registered. Let's look at what's actually required. To legitimately get registered, you have to complete all 4 of these sequential pillars. First is proficiency. That's passing your CIRO exam. Second is experience. For example, if you're dealing with complex products like options or futures, you often need a period of supervised experience before you get full approval. Third is integrity. You have to demonstrate good character. That means mandatory disclosure of bankruptcies, criminal charges, or any past disciplinary history. Trying to hide that? Huge red flag. Finally, the ultimate step, sponsorship. You cannot self-register. A sponsoring dealer has to submit your individual application, known as Form 33-109F4, via the National Registration Database, or NRD.
Section 3. Market trading and clearing. Where and how trades settle.
So, market execution fundamentally splits into 2 arenas. First, you've got primary exchanges, like the TSX and TSX Venture. This is where companies actually list their shares to raise capital and find price discovery. They're out in the open. On the flip side, you have alternative trading systems, or ATS, often called dark pools. These serve a completely different purpose. This is where big institutions trade already listed shares, usually totally anonymously. Why? So they could move massive blocks of stock without spooking the public market and impacting the price.
Think of the life cycle of a trade as a literal journey. Once you understand this flow, all those isolated facts you're memorizing will make total sense. It kicks off with the investor placing the order. Then, the dealer routes that order to the marketplace. The exchange, or ATS, matches the buyer and the seller. After execution, we hit clearing, which is where the exact obligations are calculated. Next up is settlement, the actual physical transfer of cash for securities, and finally, custody, where those assets are safely locked up and held for the client.
Let's zoom in on that critical clearing phase for a second. What happens if a dealer goes belly up right between the trade execution and the actual settlement? Well, enter the central counterparty, or CCP. A CCP legally steps right between the buyer and the seller. It literally becomes the buyer to every seller and the seller to every buyer. By doing this, it guarantees the whole trade, standardizes the settlement, and completely wipes out the risk of either side defaulting. It's brilliant. But pay close attention to exactly who that central counterparty is, because it depends on what you're trading. CDS, the Canadian Depository for Securities, handles the clearing and settlement for your standard equities and fixed income, like bonds. However, if you are trading exchange-traded derivatives, think options or futures, the counterparty is the CDCC, the Canadian Derivatives Clearing Corporation. You've really got to keep those two acronyms separated in your mind.
And speaking of CDS and equities, here is a highly specific detail you need to lock into your brain. Since May 2024, the standard settlement cycle for Canadian and North American equities through CDS happens on a T+1 cycle. That means settlement occurs exactly 1 business day after the trade date. T+1. That is your magic number here.
Okay, Section 4. Essential laws and agencies. Basically, the rules of the game.
Let's start with anti-money laundering under the PCMLTFA. If you're asked to order the 3 stages of money laundering on the exam, the sequence is always exactly the same. Step 1 is placement, literally physically introducing illicit funds into the financial system. Step 2 is layering, creating this crazy web of complex transactions to obscure the audit trail and hide where the money came from. Step 3 is integration, reintroducing those now laundered funds back into the economy so they look like perfectly legitimate assets or income. Placement, layering, integration.
As a reporting entity, you answer to FINTRAC when it comes to these funds. And $10,000, that is the critical threshold you need to know. FINTRAC requires you to file a large cash transaction report when you receive exactly $10,000 or more in cash in a single 24-hour period. But here's the catch, and it's a big one. If a transaction is suspicious, you must file a suspicious transaction report regardless of the dollar amount. Suspicion has absolutely no minimum threshold.
You're also going to need to quickly match these specific laws to their core duties. Let's do a rapid-fire review. PIPEDA, that's your privacy law, demands consent for collecting personal data. CASL is the anti-spam legislation. Every single commercial email needs consent, sender identification, and a clear unsubscribe button. And get this, fines can reach up to $10 million for corporations. The Bank Act is vital because it strictly bans federally chartered banks from tying insurance sales to creditor loans. The BIA provides the legal framework for bankruptcies. And finally, National Instrument 81105 restricts mutual fund sales practices, particularly around commissions and incentives. Memorize these matches for sure.
Finally, Section 5, Regulatory versus Criminal Enforcement, the critical exam distinction.
This is arguably the single most critical distinction you're going to face on this exam. You must ruthlessly separate regulatory power from criminal power. Regulatory enforcement, which is handled by bodies like CIRO or provincial commissions, operates on a civil standard of proof called the balance of probabilities. Basically, is it more likely than not that you broke a rule? If yes, they can fine you, suspend you, or even ban you from the industry entirely, but they cannot send you to jail. Criminal enforcement, on the other hand, is handled by the RCMP and prosecuted in the courts. Here, the standard of proof is way higher, beyond a reasonable doubt. And if convicted of a criminal offense, like fraud, sanctions can include heavy fines and actual imprisonment.
So, if the exam gives you a scenario where CIRO catches a rep breaking a rule and asks if they can lock them up, the answer is always unequivocally no. Regulators manage conduct and compliance to protect market integrity, sure, but only a criminal court operating under the criminal code has the ultimate power to take away a person's freedom.
So, the ultimate takeaway from this explainer is that you now have the structural blueprint. You've got the memory hooks for the regulators, you know the strict 4 pillars of registration, you understand T+1 clearing, and you know the massive distinction between regulatory fines and criminal jail time. With these concepts structurally locked in, you are armed with the exact knowledge you need. But I'll leave you with this provocative thought. Are you ready to flawlessly spot these traps and apply these rules when the pressure is really on in a live scenario? Review the material, trust the structure, and you're gonna crush this. Thanks for joining me today, and happy studying.